Tesla stock is experiencing some serious selling pressure in the pre-market, down a little more than 0.5%. For the week, however, Tesla is up almost 1.5%. But as you know, 2024 has not been a pleasant year, down damn near 25% year to date. It's so hard to place puts right now with Tesla being down almost 25% for the year. And I'm being punished for it. I got calls that expire at the closing bell today that'll probably end up worthless. And I got a call that expires next week that will probably end up worthless. I'm not too worried about the $230 call that I sold that expires on March 1st. Made a little bit of money and I probably won't have to sell those shares. Still a long way to March 1st. And I got a couple of longer calls, one that expires in the middle of July and one that expires in December of 2025. I have a little more faith that those two will prove a little more profitable. And should Tesla fall another 10%, you can almost guarantee that there will be another long call here for 2026.
Investors looking for bullish strategies have several avenues to reach their end goals. We're digging into those strategies via the options trade, and let's just jump into this. We got 3 different scenarios here. So we're going to take long a stock, and we're talking about risk reward because in trading, you want to have a stop or you want to have some kind of management tool there. And so we're going to take a long stock view, long call option, then long covered call option and compare them. So let's begin with long stock, and I'm going to let you set this up.
Absolutely. So especially for my beginner options traders who are out there who've never traded before or any type of trader, we have to focus on risk versus reward. So whenever we're buying a stock, the most that we can lose is the most that we spend, right? But when we're trading, we always have a price target in mind. And these are very essential components when we talk about options. We just add that layer of complexity because it's a derivative of more than just the underlying security. Yes. We've got time and implied volatility as well. So in this scenario, we're just assuming this hypothetical long stock is we're buying at the current market price of $100. We have a price target of $110, looking to make $10, which means our break even, or the most that we can lose in this scenario, is the amount of capital that we spent.
Which is all of it, but
yeah,
yes.
Exactly.
All right, now let's get to another scenario here. Here we go, long call option. Similar, but break this down, how the call differentiates the risk reward.
Absolutely. So same thing. It's important to know that we have a price target in mind. So assuming that we still have that same 110 price target, but now we're buying the call contract for 5. That means that we've got actually I believe this was moved around. I apologize. Yeah. This would be a 105 break even right here is what this is, because we would have a higher break-even price because there's a cost.
I got you.
So if we at the current market price is 100, we'll just say, well, we'll correct it right here.
Thank you.
This is 105. Now we're spending, this is a risk to reward of really, we can only make 50%. That's not very good. This is actually a poor scenario. Yeah. And I think one of the biggest risks of people going into options is they're going to start by buying calls. And if we're buying this call for 5, what you don't realize is that this is $5 from that 100 price is something you have to overcome before you actually become profitable. And that's assuming at expiration, but that's why those other factors are important. And the risk of starting out with options this way, it's important to know how pricing is really comprised.
When you're buying a call option, there is a premium that you're going to have to pay. That premium that you pay has to be added to the break even. Couple that with the date of expiration, the shorter the expiration date, the more important it is for the stock to move in that particular direction that you have decided to bet with. The longer the expiration date, the less of a monster theta can be when it comes to eating away at the premium you've decided to pay. Just a quick example of the Tesla long call that I have placed, the 155 call that expires on December 19th, 2025. At the moment, I've only made about 26%. For me to have the right to purchase 100 shares of Tesla stock at $155 per share in 2025, I had to pay a whopping $5,700. So naturally, when I bought the contract on April 26th of 2023, I bought this contract when Tesla was sitting at about 155. You add 56 to 155, and magically you get a Tesla break-even price of about $211.85. All that means is that as long as Tesla is above $211.85, I wouldn't have lost any money on this trade. Between you and me, however, I don't want this to be anywhere close to 211 by December of 2025. I'd love to see it skyrocket to 1,000, 1,500 maybe. That sure would be nice. But let's go ahead and see what it would look like if my price target were hit by 2025. If Tesla is 350, I would have simulated returns of about $15,774. Is it possible for Tesla to soar to 350 by 2025? You be the judge.
Here we have a covered call. And first, we're going to give you the definition. Investor sells a call option at a set price and expiration date on a stock that the seller owns, that's very important, in an equivalent amount. So I have to own the stock, and then I can sell a call above the current price. And here's what that looks like.
Yeah, and I see where the issue came up. It's on the previous slide. This one's 97.
Got you. We're gonna
I
fix
apologize for that. But so we'll say this one's 97. So here's the difference, though, and I'm glad we can write it down.
Yeah.
Now we're receiving that $3 premium. So in comparison to that 100, we've now reduced our risk exposure because we're receiving upfront. Exactly. So if this line here represents owning the underlying security,
Right.
have the same substantial loss potential because the most that I can lose is what I can spend. I own a stock at this point. I'm selling the covered call, so therefore I'm bullish. I'm utilizing the stock as collateral because I'm obligated to sell my shares at the strike price, in this case, our price target of 110, but I'm reducing my risk right here by $3.
Shifting it left there.
Yes, ever so slightly. Now, with options, there's a give and take. The give, of course, is this premium reduction of $3. The take is capped upwards potential. If I own the stock, I theoretically can hold it indefinitely. It can go up to an unlimited amount. Here, I'm capping my gain potential at 110.
And selling covered calls is something I like to do. I sold this particular covered call on January 22nd. It is set to expire on March 1st. I was credited $610, meaning that for the individual that chose to purchase this right to buy 100 shares of my Tesla stock, for them to break even, the stock would have to be at $236.10. At the moment, it would appear my 100 shares are safe within my pocket, along with the $610 premium that I received from the individual that would have liked to purchase my shares should Tesla have gone higher. Buying 100 shares of Tesla at $230 when you could easily just buy 100 shares of Tesla at the stock price right now. Typically, I would cover this position with a call option that's set to expire on March 1st, just in case my shares were to be called away. But as you know, Tesla is not experiencing the greatest of 2024s. For the time being, I feel fairly comfortable being naked with just selling covered calls.
All right, so limited upside, and again, we got the potential of 100% loss, but you've put some money in your pocket. We got about a minute to go here. We got lots of risks and also some rewards. Risks are leverage, complexity, time decay, and option. And I'm going to give you the floor here in a second. In terms of benefits, we got leverage, hedging, defined risk. What's the message? You got one message you could give options traders starting out. What is it?
Never hold an option till expiration. That's the worst thing you can do.
I've done this, by the way.
It's risk. If you hold the option, you lose giving up the time value. And then if you are short the option, then you actually have what's called gamma risk, and you have a huge issue of being unprofitable very quickly. So trade small, trade often, as they say at Tasty Trade.
That's actually really good advice. Never hold a trade to the expiration date. I suppose every dollar will count. Here's a prime example. I bought a $195 call on January 30th, set to expire on February 2nd. I needed the stock to move in a particular direction, and it did not. Here we are at the expiration date, and I'm hoping Tesla has a 6-7% movement to be profitable on this trade. That is highly unlikely. Now, I paid $280 for this contract. It is currently valued at $22 and going to decline extremely fast due to theta. The wise decision would be to wait for a particular spike at the opening bell today and just sell it at a loss. Every dollar should count, but sometimes I get so frustrated I'd be like, it. Let it wither on the vine. Now, I haven't had any good calls in the year of 2024, but I did have one put that was pretty juicy, so it's kind of made up for it a little bit? Probably not. I am not deterred with my options trading. You're gonna win some and you're gonna lose some. The key is to keep track of it all and try to learn from some mistakes, because there's going to be plenty along the way. That's all I've got for you today. Be easy. Peace.